Nvidia scored a 98 out of 100 on my health check. Grade A, not a single red flag. And the very same analysis turns around and flashes a warning on the stock itself. Wait, the price assumes too much. So which is it? Here's the tension the headlines skip. That price is leaning on earnings that have to more than triple in 3 years, and more than half of last quarter's sales ran through just 3 direct customers. A near flawless business, and a stock the model says to sit on your hands for. Stick with me. By the end, you'll have a straight read and the one date that puts it to the test. Let's scout it. Start with the business. The whole puzzle only matters if the company is actually that good. So let's verify the grade instead of trusting it. Return on capital, the report card for turning $1 in into more than $1 back out, is elite. Gross margin runs near 75%. 75 cents of every sales dollar is gross profit. For a company shipping physical hardware, that isn't normal. That's software-level economics. And the engine underneath it, last quarter, Nvidia did $81.6 billion in revenue, and $75 billion of that, 92%, was its data center business, up 92% in a year. 92% growth at $80 billion a quarter. Numbers like that are usually a typo. This one isn't. And the package scores its debt as manageable against the free cash flow it throws off. So the grade holds up. A, 98. The business is the real thing, which is exactly what makes the warning on the stock so strange. Here's where it gets interesting, because you'll hear that Nvidia is cheap. And on the surface, it looks that way. The stock trades around 22 times next year's expected earnings versus its own 5-year average north of 60. Quick definition, because it's the whole trick, that 22 times is a price-to-earnings ratio. Today's price divided by an estimate of next year's earnings, not the earnings already reported. So it can look cheap for a dangerous reason, because the estimate is forecast to jump. And look what this one assumes. The model runs a matching analyst earnings series, an attributed series whose exact accounting basis the provider doesn't disclose, so we read it on its own terms. It starts at a base of $4.69 for the current fiscal year, then assumes $9 next year, almost $13 the year after, and over $15 the year after that. That's the bet. Earnings more than tripling in 3 years with barely a stumble. So the multiple isn't really cheap. It's borrowing from a near-perfect future and calling it today's price. It's like buying a house at a price that only pencils out if the neighborhood gets a train line, a stadium, and a Whole Foods, all of it on schedule. Maybe it happens, but you're paying today as if it already did. So I don't guess, I run the odds. 3 weighted cases. And these are planning weights and assumptions, not the odds you make money. Watch the assumptions because they're the whole story. The base case, call it even odds, assumes near-term growth cools to about 34%, settles to 10% long run, at roughly an 18 times exit multiple. You make about 11% a year. The upside, a quarter of the weight, still needs near-term growth around 25%, 12% long run, and a richer 21 times multiple, and even then only lands near 10% because so much good news is already in the price. And the downside, the other quarter, near-term growth cools to about 20%, long run fades to 3%, and the market re-rates the stock down to roughly a 15.5 times multiple, meaning investors decide each dollar of earnings deserves less, and your return falls to basically 0. Sit with that spread. Best case and base case both land around 10, 11%, and the downside is a flat line. Weighted together, the model's expected return is about 9%. Under the 12% it treats as the required hurdle for this kind of risk. That's why the read is wait. Little reward if it goes right, real pain if it doesn't. The reusable rule: when a stock looks cheap on a forward multiple, always ask what the estimate has to deliver, and who has to keep spending to make it happen. So, not cheap, priced for a great decade with almost no room for a bad quarter. Which brings us back to that second number. More than half of last quarter's revenue, 54%, came through just 3 direct customers, 21, 17, and 16%. Now, The filing does not name them, and it's counting sales channels, not end buyers. So I won't pretend it's 3 companies you can name. But the shape matters. When this much revenue leans on so few doors, the whole story depends on those buyers keeping their budgets aggressive. Good news for the bulls. They are. The giant cloud players are collectively spending hundreds of billions this year building AI capacity. That's CapEx, the cash they lay out on data centers before the AI revenue shows up. But CapEx is a promise, not a guarantee. And the tell isn't only whether they keep spending, it's whether they're earning a return on what they've already built. So I'd watch utilization, whether those expensive servers are busy enough to earn their keep like a restaurant's tables at dinner, because that shows the spending stays rational. So, demand is real and huge, but it's concentrated and only as durable as a few buyers' budgets. Okay, jokes aside, this is the part that decides whether that estimate stack holds. Both sides have a real case. The bear case first, because it's the one to respect. A digestion phase, a pause to absorb what they have already bought, is a genuine risk any time a handful of buyers build this fast. That concentration cuts both ways, and those buyers now have alternatives. AMD's data center business grew 57% last quarter, smaller than Nvidia, but real and improving. And the biggest customers are building their own chips. Google has its TPUs, and Amazon's chip business, Graviton, Trainium, Nitro, is already past a $20 billion annual run rate. None of that dethrones Nvidia, but it chips, pun intended, at the idea that the next 3 fiscal years are a clean line straight up. The bull case, though, isn't a slogan. The execution is extraordinary. The data center economics we already walked, and the product cadence is relentless. Blackwell is ramping now, and the next platform, Rubin, is already slated for the back half of this year. So the whole stock rides on one question. Does that near-perfect earnings path arrive before a pause, a competitor, or a custom chip takes a bite? The business will very likely be fine. Whether fine clears this price is the real fight. Last check, the chart. A stock priced for perfection should act perfect. This one doesn't. Walk it in order. First, the moving averages. A moving average just smooths the daily noise into one trend line, like stepping back from a jagged hiking trail to see whether the mountain is actually rising or falling. Right now, price is below its 50-day line, but still above its 200-day. The recent slope has weakened, while the longer one hasn't broken. Next, momentum. There's a gauge called MACD, and when its faster line drops below its slower signal line, it's telling you the recent push is losing steam. That's exactly where Nvidia sits now. And the point and figure board, that one ignores the small daily wiggles, like muting the crowd noise so you can just read the score. It's in a bearish posture too. Put it together, and the model reads the chart as defensive with no confirmed setup to go long. One honest caveat, just reclaiming 212 wouldn't be the all clear on its own. The model wants the moving averages to resolve, momentum to confirm, and point and figure to agree first. So the chart is defensive. Price isn't confirming the story. So put all 3 on the board. Health, pass, grade A, 98. Value, fail. You're paying for a decade of perfection with little margin for error. Chart, fail, defensive, not confirming. Scout's Field Report, elite operating proof, demanding assumptions, and a chart that hasn't confirmed them yet. The current risk-reward read is a watch, not a chase. That is, analysis, not a recommendation. Your call depends on your own research and your own tolerance for risk. What would move it? Mark August to 26th. Nvidia reports guiding to about $89 billion. Clear that with data center strength and no crack in demand, and the bull path firms up. A soft guide, or a hint the big buyers are starting to digest, and that cheap-looking multiple gets expensive fast. On the chart, I'd want the moving averages to resolve and momentum to confirm, not just a poke above 212. The August 26th print is the next piece of evidence, not the answer in advance. And that's a read, not advice. This is educational. I show you the work, you make the call. Do your own homework. Want your ticker scouted next? Drop it below, subscribe so you catch it, and I'll see you on the next one. Scout, out.